Good afternoon, everyone. My name is Chelsea Shapiro. I'm ORSID's Director of Business Strategy and Growth. We are thrilled to have you all tonight for our 2026 Budget Preparation and Insurance webinar. I would like to introduce our hosts for the night, Andre Kaplan, our CFO, and Eric McPhee, our Executive Vice President and Director of Risk Management, who will be taking you through the presentation tonight. I will be your moderator. We will be doing a quick Q&A at the end of the presentation. So if you have any questions, please submit them to the Q&A at the bottom of your screen. The chat and the Q&A are different functions, so please submit to the Q&A any questions, and we will get to some of them at the end. So thank you again for joining us. I will kick it over to Andre to get us started. Andre?
Thank you, Chelsea, and welcome to our 2026 budget. And for the first time, we are combining our insurance webinar. I believe that many of you know me that are in attendance tonight. However, for those that have not had the pleasure of meeting, I'm Andre Kaplan. As Chelsea said, I'm the Chief Financial Officer at ORSID, and I have been navigating budgets in this industry for over 30 years. I hope that you find our webinar insightful and beneficial. I'm very, very excited that Eric McPhee, our Director of Risk Management, is joining me tonight to give us some good information in terms of the insurance markets and some guidance. As some other introductions that I would like to make for certain team, our controllers behind the scenes that do all the work in assembling the budgets annually. And so I'd like to make the introductions. At the top of the screen, our senior controller department team is led by Joe Dodai, Ben Hawkins, Salvatula, and Oleg Tryakov, as well as our amazing team of controllers and financial analysts that do all the hard work: Rob Dessel, Andre, another Andre, James, Ashley, Ada, Rainier, Dorel, Carolyn, Adelina, Isa, and Aya. And you will have the pleasure of meeting them as we move through our budget season. I want to make a special acknowledgement to Ben Hawkins for his involvement in assembling this webinar, and a special thank you to Joe, Sal, and Oleg for their contributions for the presentation tonight. This presentation will be recorded, and so you will all receive a copy of the recording. I hope that you find this useful. Moving into the some areas, we have a lot of ground to cover tonight. Some of the particular areas I'm going to move through fairly quickly, and then there are going to be other areas where I'm going to spend a little bit more time. We've added some additional content that we believe is very relevant for 2026 and for forward planning. And so there I'm going to spend a little bit more time. Some of the other items where I have historically addressed, for those that haven't attended our webinar before, I'm going to cover those, but maybe a little quicker than other areas. So moving into the basic budget composition, and this is for a cooperative, and looking just big picture, what makes up your monthly maintenance, what goes toward, what drives it. And you can see that 50% is real estate taxes, followed by payroll of 27%. And then you can see that your utilities, financial being your mortgage, insurance, which used to be a much smaller piece of the pie, now makes up 6% of your annual maintenance that you pay. And repairs, supplies, and other is 4%. Most of these costs we have very little control over. However, that does not mean that we cannot make every effort to negotiate or strategize to move the needle in some form or another. In terms of a condominium, composition is a little different, although one must not neglect that or ignore the management as much as we can of the real estate taxes because it's a real carrying cost for owners of a condominium. However, in terms of the big pieces of the pie, it's payroll. Again, payroll driven mainly by 32BJ, which is the union contract, which I'm going to talk about in a little bit more detail later on, your utilities, insurance, and repairs and maintenance. Let's go into the biggest piece of the pie, which is your real estate taxes, which makes up literally half of what you pay in terms of your maintenance, or even in a condominium, in terms of what the real estate tax is, the cost of ownership. Really, half of that in terms of between your common charges and real estate taxes is what makes up your payment. So real estate taxes are calculated with two factors, one being the assessed value, and we will talk about the transitional assessed value, which is a phase-in, which I will explain on the next slide, but it's a function, it's calculated as if your building is a free market rental building. They look at comps in your neighborhood, and they calculate this on a per square footage basis and apply it to the total square footage of your building. There's a grievance process and a 5-year rolling average. And the grievance process really is to look for supporting comps in your neighborhood in terms of free market rent that is lower than the per square foot dollar amount that they've applied in terms of assessed value for your building. But it is driven by free market rents, and it's on a phase-in and a 5-year rolling average. And the second part is the tax rate. Now, with regards to the tax rate, this tax rate is really dictated by the city's budget. The city relies on almost 60% of its revenue comes from real estate taxes to fund the operations of the city. And so therefore, we are at the mercy of the city council's budget. Let's talk about the assessed value, which is the first component on the calculation of the real estate taxes. And as we talk about the assessed values, we talk about the rental market, which I explained to you. The second part is the 5-year. This comes into play with the 5-year rolling average, and it's very, very important to understand this. So for here, I'm just going to take a pause. During COVID, in the 2021-2022 tax year, and you can see here it's highlighted in blue on the chart on the right-hand side, you can see that everybody, on average, they reduced as tax relief due to COVID and the pandemic, they reduced on average the average assessed value by 11%. If you recall, during that time, the rental market was extremely soft and everybody was hurting. And so that was across the board. Now, because assessed values work on a 5-year rolling average, each year, and it's unique to New York State, every year the assessed value is adjusted or you are reassessed. And there's a phase-in. So each year you get a new average value in terms of assessed value. And you can see that on the chart. And every year, generally, we assume it goes up 5%. And then it gets phased in over 5 years, which you can see on the far right-hand side, which is called the transitional assessed value. So every year that 5-year value gets adjusted. So even if they don't increase your assessed value, unfortunately, your real estate taxes in terms of assessed value is going to go up because of the 5-year rolling average. What's particularly important for the 26 budget year is because we got an artificial reduction because of the pandemic of 11% across the board on average in assessed value, that low value is going to drop off because of the 5 years. It's hard to believe that we were in the deepest, darkest depths of the pandemic 5 years ago. That is going to drop off and the higher values are going to phase in. And what that means is where we saw maybe a lower value in 23, 24, that is you possibly going to see a bigger adjustment in the assessed value in your 26, 27 tax year because of that artificial low assessment that's going to drop off. So the impact, could be a lot greater than we have seen. The second part is what we call the RPIE effect, and that is the real estate property income and expense report that we file in terms of rentals. Now, the city's data is lagging. They're currently working on 2023 data. Only 24 is starting to phase in. So where we haven't had a huge rebound in commercial, but some rebound that is going to follow through. Where there hasn't been a rebound, where there's commercial income in your building, that could have some effect. We did start to see this last year when the 23 data started to fall in, and that could have a positive effect where there's commercial revenue on assessed values. However, because of the high demand for and rental market on the residential side is strong, and as I said in the beginning, assessed values are calculated on free market rentals, that could continue to drive assessed values up, especially with mortgage rates being higher than we have seen in prior years. It's only people are renting, and therefore rentals are even stronger than before. Just in terms of other factors that we need to consider, the positive is that the co-op tax abatement or the condo abatement program, which was last renewed in 23, will probably continue through 27. There is a lot of talk about tax reform and how that is calculated beyond 27, but at this stage we will assume that the abatement program will continue, although I can't say after 27, but we know that it will stay in place through 27. So, and that is on average 17.5% of your real estate taxes is the credit that we receive that is spread amongst owners in terms of the benefit to owners. And moving forward, in terms of, just want to make sure that I haven't missed any other important factors. And then just last, just to reassure you that we do appeal every year. So every building has a tax cert attorney. We do file an appeal every year, based, as I spoke about, looking for better comparables in terms of market rentals so that we can reduce those assessed values. We are seeing less offers than usual in terms of offers of reduction. However, those are still being determined. Most of those offers have flowed in and will continue to flow in through October. We will obviously continue. The next appeal is in March, and we will file to hold that appeal in terms of we haven't received an offer of reduction to carry that year as an open year, open until we get a final offer or no offer, but it's before the tax commission hearing. So we are continuing to pursue that. Moving on to the second component of real estate taxes, which is the tax rate, which is dictated again to fund the city. Last in the 23-24, you can see there's a history going back to 2009, 2010, where that was the last big increase. You can see really even a reduction or no increase all the way through until 23-24, where we saw an increase. 24-25 was no increase. Last year, again, 1% increase in the tax rate. The city's fiscal year runs from July 1 to June 30th. Generally, the budget is passed calculating this tax rate, what is needed to fund the city, in November, and therefore they retro bill the adjustment or the increase in tax rate to July of the prior year. So we will apply that increased rate, which is the assumption that we're making, about 1%, will be applied in the first half of the real estate taxes in your 26 budget. So we will account for any increase in the tax rate in the first half, and then there'll be a blended rate, and that will be addressed in the first half of your budget for 26. And hopefully we will see that increase. But the assumption is that there's not going to be a huge increase in the tax rate, and we're rather going to have a lot more exposure on the assessed value. But the bottom line is the city needs to be funded, and that's really what it's about. There is some talk about the reclassification in terms of the classes, in terms of tax rates, because residential as opposed to commercial gets taxed at a different rate, and because of the commercial real estate not performing due to hybrid workplace environments, that they might look to give more relief to commercial owners, and they will need to spread that burden. But more to come on that. And again, as I mentioned, 50%, this is a big impact. The one thing that we do, and we will let you know, is that when the new assessed values, they are published in June of every year, and we go back and look back at what we budgeted for, we will let you know, and we have, and we do every single year, we will let you know if there's a big variance, so that we know ahead of time that there are no surprises. If there was any major adjustment in the current year, and there, for your building, you would have been informed. And so we do, in the middle of every year, we do a thorough look to make sure that whatever we assumed as the assessed value adjustment, that it's within your budget, and that you're not going to have a surprise at year end or going into next year. That gives you the opportunity it gives you the opportunity to take corrective action or advise your shareholders of this pending adjustment that was out of the norm. We also, in the prior year, we took part in the benchmarking for Local Law 97, which I'm going to talk about, which talks about building measurements. Again, your building's assessed value is calculated on square footage, and your manager, account executive, will talk to you in more detail. And we have discussed this before in terms of matching the city's data, in terms of are they billing you the correct square footage, and that is still flowing through. Let's move on to the next category, which is the second biggest piece of our pie, which is payroll. Oh, sorry, I skipped one section, which I mentioned to you, is the J51 Reform Tax Incentive Program. This covers a wide range of capital improvements. It's 70% of the approved cost amount could be covered. The credit will be spread over multiple years. This is for 25-26 eligible filing. However, most buildings, in fact, 99% of the buildings that are present at this webinar this evening do not qualify, because the assessed value per unit ratio has to be under $45,000. But I just want to let you know that there are a few buildings in our portfolio, and those have been addressed and filed for. Apologies. Let's move on to payroll, which is generally governed. Most buildings, but not all, are governed by the 32BJ contract. That contract is up for renewal on April 20th, 2026. You can see at the end of this contract, the average cost, overall cost, all in, per person is $121,000. And if we had to apply the average increase that we have seen in historical contract renewals, going back to 2012, 2013, that if the increases remain constant, as we've seen, that the average cost at the end of the next 2030 contract, the average cost all in will be approximately $169,000. There are automatic step-ups every year. It's generally a 4-year contract. There's always the possibility, as we talk about every year, in terms of a possible strike. So we have already established internally a strike task force built into your 2026 budgets. There's an anticipated cost for the strike that would be For security guards, should your building elect, unless you lock the doors, that would be for a dumpster for garbage and things like that. We're building all those possible eventual costs into your 2026 budget as a placeholder. As I said, the average cost is $121,000. And the other thing that we need to be mindful of is that part-time staffing and union audits. And this is a real thing in terms of if you utilize part-time staff and you're for either a particular reef or somebody that's out sick or for a capital project, it needs to be well documented, because if they work more consistently, more than 16 hours a week, you could be eligible for union benefits for that part-time worker if they're not properly documented in terms of what their particular role is and why they're there. If that's just covering because people are out sick, or for relief worker, you could be eligible for $35,000 additional benefits for this part-time worker. So we need to be mindful of these audits. Sometimes the analysis needs to be made in terms of what is the cost of overtime as opposed to the additional benefit that you could incur to pay to the union of an additional $35,000. So we need to be mindful and make sure we monitor that very, very carefully. We are going to keep, as I said, the budget consistent, as we've seen with prior contract renewals, on average 4 to 4.5%, and that is the intention in terms of the range. Moving on to prevailing wage. Now, in order to qualify for the co-op abatement, which I mentioned under real estate taxes, which is 17.5% credit, if your building is non-union, that's number one, and you utilize security guards, the compensation needs to equate basically to the wage plus supplemental benefits as if they were a 32 BJ union member or controller's office requirement. And that is set by the controller's office. It's on average $47 an hour. And you can see that this came into play in 2022, completely phased in into 2023. And you can see historically that if you had a non-union employee or a security guard that was earning $17 an hour, with an annual increase, receives 5% with no benefits, you are now required, in order to qualify for the co-op abatement, to pay the $47. And you can see that, which is the highlighted in blue, the additional incremental. All buildings, we have addressed this in terms of who needed to comply and the phase-in. We have addressed this in your budgets. Any building that are on the cusp, and this you'll qualify in terms of assessed value per unit. So if you're over 30 units and you have an average assessed value of 60,000 units, $60,000 per unit, or if you're under 30 units and you have an assessed value of over $100,000, you need to ensure that you comply with the prevailing wage. This also goes to all staff or any services of staff that would provide similar services to if they were a building staff employee providing cleaning, landscaping, or anything of that nature, security guards or building staff. But we can assist you with the analysis. We will be bringing this to your attention if you're on the cusp in terms of the assessed value that you need to comply. So there's no concern. We will be bringing it to your attention. And for those buildings that needed to comply, that has been addressed and phased in. And we will take you through the analysis, the pros and cons, and what the cost benefit is of either foregoing the abatement of the 17.5% and what is the cost benefit between the cost of complying with that prevailing wage. Next, in terms of semi-annual tax billing, that's something else that one needs to be aware of in terms of assessed value. So we spoke about assessed values complying with prevailing wage, and the impact of the possible abatement for condominium and co-op unit owners. The other factor that one needs to consider for buildings is the ratio of the assessed value if it's over 250,000. And if your building hits that threshold, okay, which will be in the July and October taxes, might basically need to effectively both be paid in July. So what does that mean? So hypothetically, if you pay generally all real estate taxes are paid on a quarterly basis, and if your real estate taxes are $600,000 a quarter, and you now go over the threshold of the $250,000 assessed value, and you have to now pay your taxes semi-annually, you basically are paying 6 months as opposed to 3 months of your real estate taxes in advance. And what this does is it means that you are going to have to fund the additional differential from your reserve fund because we only escrow, or the bank only escrows per quarter, and we all of a sudden have to come up to pay an additional quarter of real estate taxes in advance. So that means you're going to have to fund another additional 600,000 from your reserve fund. So $600,000 that you thought you had cash available in your reserve to fund capital needs is no longer going to be available because you're going to have to fund real estate tax in advance. It's purely cash flow, but something that you need to be mindful of. I'm going to move on to general sort of professional fees, repairs, and supplies. So this is in terms of vendor compliance, in terms of insurance requirements, which drives up costs, rising energy, tariffs that have been imposed, and then led to, other the many other compliance matters that we need to address, which is going to impact professional fees, repairs, and supplies. And items are your elevator inspections. There's a 5-year test, there's a 1-year test, there's a new annual parapet inspection that we spoke about. There's a 2024 natural gas installation requirement. There's the local law 97, the benchmarking requirement. These are all costs that we have to comply with. That's driving lead paint testing, climate mobilization 97 filings, in local law enhanced 84 benchmark filings relating to 97, and the list just goes on and on. Boiler inspections, backflow preventer inspections, drinking water tower must be inspected. If you have a cooling tower, bed bug filing reports, all these compliance is constant, and it's adding to the cost of compliance in your operating budgets. We're building all this in, but and the list goes on and on and on, and it's exhausting. So just to be mindful of that, and it's very challenging in dealing with the budget, but these, again, are imposed and consistently imposed, which is driving cost of maintenance and common charges. Moving on to utilities, in terms of, let's talk about oil. And so oil prices have stayed under the $3 per gallon, due to the OPEC production, potential global economic slowdown. However, we are going to be conservative because it's always a volatile market, and we're going to keep that. Even though we're below the $3 mark, we're going to be conservative and continue to budget at around the $3 per gallon. Let's talk about electricity and natural gas, another volatile market. Con Edison, again, have applied for a large increase in delivery costs. So they're looking at a 20% increase for gas, and a 16% increase that they've applied to for electricity in terms of the delivery costs. And bearing in mind that 70% is really, it relates to the delivery and 30% to the supply. So the 30% of the supply, which we're going to talk a little bit about in terms of ESCOs, but basically we are looking and subjective to big increases in the delivery portion again, and therefore we are going to keep consistent as we did in prior years with assuming a 10% increase for gas and an 8% increase for electricity for 2026. Gas costs are slowly but surely creeping up, and again, a volatile market. So in terms of pricing options, again, as I mentioned, limited portion of utility budget that we can control in terms of the delivery, and then hedging fixed price options, what's right for your building. Now, I'm not a hedging advisor. However, I would proceed with caution if you are considering this. The cost to lock prices. So for oil, it's on average an additional 10% over the cost price. Natural gas, 40% over the winter strip, which is extremely expensive. And electricity, over 100% over the spot price for the 25-26 winter strip, which is generally elevated. The risks of speculation, as I said, should be carefully considered. Also, the energy recommends bidding out the ESCO basis, this portion of the above the index of the supply side, 12 to 24 months. And we will be providing those options to you. And this ensures a competitive market price for the portion of your total gas electric bill. And we shop those ESCOs. We're not going just to one ESCO. Again, it only relates to 30% of the utility portion. At this time, I'm going to pass baton to Eric McPhee to talk about the insurance market and the insurance component to the budget. So Eric, over to you.
Thank you, Andre. I think many of you know me, but for those of you who don't, I look forward to working with you in the future. How's my hair look, Andre? We're good?
Nearly as good as mine.
All right. Very good. Well, this has been riveting so far, so hopefully I can keep up my end of the bargain here. I'm going to really cover sort of three buckets. We'll talk a little bit about insurance premiums and then risk management efforts, things that we've done, up to this point, we're looking at going forward. And then I'll spend a moment to just introduce a report that I found very interesting from the Partnership for New York City. So let's start with the insurance premiums. I think that's sort of the nuts and the bolts. What everyone's most interested in is how much is insurance going to cost in the coming season. So overall, we're recommending at this point a 10% increase for budget purposes, and the factors that are influencing that projection I'll talk a little bit about. Last year, I would say most buildings fell either under or very close to the 10% that was budgeted. We had a rate lock agreement last year. I'll talk a little bit more about the rate lock agreement that we're looking at for May of 2026, and some of the other factors. The total insured value, or the TIV, can impact the overall pricing, so that's something that we'll have to consider. The building values and business income limits are what sort of make up the TIV, and we'll have to analyze that to see whether or not we're on market. Last year, the TIV we were able to keep fairly stable. Greater New York Mutual, who's our primary partner insurance company for the package policies, does contain a 4% inflationary increase clause in our endorsement, rather, in their policy. And so they do have the right to increase it. Last year, we were able to negotiate to keep those values pretty flat because, for the most part, our buildings have done a good job of keeping up with the inflationary costs of reconstruction and construction. On the D&O side of things, while the for-profit D&O market has softened a little bit, the nonprofit D&O, which is where we are, is a smaller niche segment, and it remains relatively strained in New York due to the high cost and frequency of litigation. So we're still, contemplating some higher D&O increases. Fortunately, even an 8 or 10% or even 20% increase in that market reflects a smaller portion of the overall insurance budget, but just by premium volume. The workers' comp market remains soft and dividends are healthy. So primarily, most of our buildings are in the the Dernan program, and that program remains very strong. In fact, it's the strongest workers' comp market in the industry. I think they declared something around a 40 or 45% dividend recently. So that's a really healthy dividend. The Greater New York Mutual rate lock agreement last year was right around 6%. With some minor adjustments, we ended up probably closer to 7%. And then we saw some larger adjustments on the umbrella side of things, depending on the size of the building. This year, I'm happy to report that GNY has agreed to a 5% package premium rate lock, subject to some performance restrictions. So overall performance of the portfolio will need to be, 50% or better on the loss ratio. And as has been the case in the past, buildings that are really significantly driving the loss ratio won't qualify for the rate lock. We'll have to negotiate separately, as they're going to likely see some higher premiums and perhaps deductible adjustments. But nevertheless, this program has been in place since 2015. And even for those buildings that have had some claims, I have to say, I think we're doing better than market. And we'll talk a little bit about that later when I talk about some of the value. I think that, buildings that have, significantly, contributed to the loss ratios are going to be in somewhat of a different boat. They will not be non-renewed. That's, sort of part of the deal is that, we'll have to come up with another strategy for rehabbing the building's performance, but a non-renewal notice will not be part of that strategy. Just to spend a moment to touch on the performance of our program, sort of past and present. A question that we often hear, particularly from buildings that have just come into the Orsett family and are looking to join the Orsett insurance program. First question I almost always hear is, how much will we save? And it's important to note that the Orsett program is not a quid pro quo. There's no promised instant savings just for joining the program. But what there is a demonstrated savings over time and high quality of service. And Andre, if you want to just pull up that illustration just for a quick moment, I'll just spend 2 seconds kind of going through that just to sort of demonstrate what I'm talking about. Let's see. I can't pull that up a little bit, make it a little bit bigger. Okay. So this illustration is something that exists for those buildings, at least that are in our portfolio. It exists in every one of your insurance why am I blanking on this? Every one of your insurance proposals. So each year when we go to renew the policies, you'll likely get an insurance proposal that contains a lot of information. This chart is something that I've developed with both of the brokers who service our portfolio. This is the IMA chart, which is a former York International, and Owens Group has something similar that we've developed together. And it covers some of the information that I think is important for the boards to see in sort of a snapshot view. Let's see if I can adjust this because I'm having a hard time seeing the whole thing. In any event, it tracks the package premium, and this is a 10-year tracking device. So it tracks, if we've been with our program for 10 years, it'll track 10 years performance of package premium, property incurred claims, liability incurred claims, and the labor law claims, if you have any, hopefully not, are highlighted. Then it talks about the package incurred claims overall, D&O premium, D&O incurred claims, and umbrella premium. And then the building value is on the bottom line there in this example. And so the purpose of this is to sort of demonstrate in a visual way sort of how the building has progressed over the past 10 years. How have your premiums changed? How have your claims experience changed? And all of the metrics that we just discussed. And then in the bottom part of the chart there, or rather in the second part of the numerical chart there, you can see there's a package loss ratio, industry package premium trend, and then the package premium trend for your building in particular, and which really reflects the portfolio based on the rate lock agreement. For your building individually, if you had a spat of claims, you may not have qualified in one year or another for the rate lock, and so you might see a different number. But by and large, this example is for a building that hasn't had a significant claims, or rather any claims experience in the last 10 years. And so just to show you sort of like a level playing field, otherwise it would be very hard to demonstrate, one building from the next, because each building's claims experience is unique. But this particular example shows if you had no claims over the past 10 years, sort of how you would have panned out and how this building in particular panned out. And so what it reflects, which I think is really important to note here, is if you look at the industry package premium trend versus the package premium trend for this particular building, you can see that over that same period of time, over that 10 years, the industry package premium trend was 150% increase. And for this building, it was about 40%. Now, I looked at a sampling of different buildings with different claim scenarios, and I would say that the range was between 40%, and I would say in the examples that I looked at, up to about 65%. So even some buildings that had some claims were able to be well under the industry average. And just so you understand sort of where that average comes from, these brokers, both IMA and Owens Group, are brokers that write a significant book of business in New York City. And so they are seeing things outside of the Orchid portfolio that aren't necessarily visible to us. I will say that, I do have visibility to the outside of our portfolio every time a new building comes in, and I start to dig into what their premiums look like, what the history of their premiums are, the levels of insurance, so on and so forth. And I can tell you that these trends sort of prove out. And for those folks that I've met with who've recently joined our program, we've sort of gone through some of these numbers, and they've seen that it's proved out also in the history of their renewals. So I just want to bring this chart to your attention. I think it reflects a lot of important data points that are worthy of consideration when you start to think about how the program benefits the buildings. It's not always an instantaneous savings, and don't get me wrong, there has been scenarios where buildings have come in and are just not written as they should be, and for whatever reason we're able to, or for, a variety of reasons, we're able to get a pretty significant decrease in the premium. But that's not always the case, and this chart sort of really demonstrates the value of the program. All right, Andre, if you want to just go back to the other page. Okay. And so notes. And so the other part of this, this overall recommendation is, we're talking about, even though the 5% rate lock agreement sounds great, the umbrella markets still remain quite volatile. While our primary umbrella market is stable, it's more expensive than we'd like. And so we've reached out last year and spent, I would say, a good amount of time putting together a program with an alternative market. That market we were able to place on a pilot program basis about 30 buildings, and the average savings was about $30,000 per building. So a significant savings, and we're hoping that we're going to get many more buildings into that program this year. There are some limitations. There's a $100 million limit, but there's no excess D&O coverage, which we can talk about at the time if it comes to that, and how we're working around that. It does require GMY's underlying $5 million buffer. Buildings that are over 30 stories don't qualify currently, and it is all subject to underwriting approval. So there could be some things going on in the building construction, some other things, violations that we may have to overcome. But nevertheless, we were pretty successful last year. The cost savings, I will say, is most beneficial to the smaller buildings that were previously subject to some really high minimum premiums, as you've likely experienced in the last couple of years since the umbrella market started collapsing. Just to spend a quick moment on our risk management efforts, we've had a tremendous amount of success on our risk transfer program through BCS and SDV. If you don't know what those programs are, I'm happy to spend some time with you separately from this webinar. I think most of our buildings are aware of it. We've talked about it in some memos that have gone out. And what that does is really vet the contractor's insurance to make sure that the risk transfer is going to be successful if and when there's a claim. One important takeaway from this is that sidewalk claims are an emerging trend and highly susceptible to fraudulent claims. So if you are considering your capital expenditures and sidewalks are sort of on the fence, do we do it now? Do we do it later? My gut would be to encourage you to do it sooner than later, because the fraudsters are out there and they are looking for sidewalks that are in disrepair so that they can, bring claims forward against these buildings. The values of the legitimate claims are also escalating. So when you combine the values of the legitimate claims and then the tremendous amount of fraudulent claims that seem to be coming through, it amounts to quite a lot. and the burden on the insurance company is hard, and it's something that will be passed back to the insureds if it becomes a bigger problem. The other thing I'll touch on quickly is sort of the next frontier, as I see it, is homeowners insurance and closing the loop on labor law claims. Another emerging trend that we've seen is that through apartment alteration projects, a number of labor law claims have come to light. It's both a shock to the homeowners, unfortunately, the shareholders and unit owners who own these units and who are undertaking this work, who have no idea in terms of the visibility and the potential for these labor law claims. And so we'd like to change that and be in a position to educate them and make sure they're properly insured, and also make sure that their insurance is being vetted and, inures to the benefit of the co-ops in particular, because it's a unique exposure there, and also to the condominiums. But the apartment alterations are certainly a pitfall for labor law claims, and that's something that we want to start to address with the individual unit owners and shareholders. And I'll just spend a quick moment and a quick thank you and shout out to Adam Emmerich, one of our esteemed board presidents. He directed us, or rather provided us with or directed our attention to this Partnership for New York City report that was recently published that analyzes the impact of excessive litigation costs on affordability and housing and business development in New York City. We will be sending out a link to that. I think Chelsea said she's going to put one in the chat. And I found the report to be fairly comprehensive. It deals with broader issues that we're focused on here at ORCID, but it provided a very succinct explanation of what the challenges are and offers some potential recommendations for how we might address them. Particularly found the sections on modernizing liability statutes, increasing transparency in litigation financing, and discouraging fraudulent claims of interest, and very applicable to our concerns. I think I've gone over my time, so I'll leave it with that and turn it back to Andre. Thank you.
Thank you, Eric. Moving into mortgages. So firstly, and I'm going to spend some time on this, and there's a lot to discuss, but, fortunately, most of the buildings, you're locked in generally until 2030. And it's important understanding the different products that are available in terms of the mortgages. So looking back to 2021, the average 10-year loan was around 3%, and it's gone as high as 6.75, and we're averaging around around 6% right now, 6.3. If you had to look at a 30-year trend or not more, or a 50-year trend, we're still below the average, which was around 8%. Although, for the last 20 years, we've enjoyed a low interest rate environment. It's a big concern and a big topic of conversation amongst board members and of, when those mortgages reset and how are we going to deal with it. And help is, I don't have the solution, but help is on the way, as it were. So just in terms of understanding today's market, many lenders have left the co-op world in terms of lenders. So there are two main types of products. One is a Freddie Mac Fannie Mae, which is a traditional loan mortgage. Most buildings generally it's a 10-year term, and they are subject to a yield maintenance provision. So that means if you come to refinance the mortgage, in simplistic terms, it's the spread over the 10-year treasury that you have to make whole for the remainder of the loan term. So if you've got 5 years left on your loan, you have to pay the interest component on the spread forward in order as a prepayment penalty to refinance, and some of it can be cost prohibitive and very, very expensive. The second type of product is what's called a portfolio loan, and that generally has a little bit more flexibility. It's not subject to yield maintenance, even though they are classified as commercial loans. They're all subject to prepayment penalties. However, that's generally on a 3% on the first. It's on a sliding scale, 3-3-3, so 3% in the first 3 years of the principal balance, and goes down. And some of them have a little bit more flexibility that you can pay interest only, or you can elect to pay up to 10% of the outstanding balance in each given year as amortization, or you can go with a traditional 30-year amortization schedule, but it's linked to a 10-year term. There are through life companies such as John Hancock or Principal, where you can do a 30-year. That is very restrictive for co-ops because they've relied historically on funding through debt, or generally, although the landscape is changing, and I'm going to talk a little bit about that. Those are generally for mortgages for 5 million and above. They don't generally look at co-ops under the 5 million threshold. And again, as I said, many lenders have left the market for the co-op world, and there are left what we call product loans, which are not subject to yield maintenance. There are not many lenders still in the market. And there are lenders that are available in the market are doing a detailed analysis as to whether they will be interested in lending to your building or not. That doesn't mean that there are no lenders available. There are plenty of lenders available. You will always be able to refinance your mortgage. So please don't be concerned just that there isn't a lot of competition out in the marketplace right now. So we're going to look at the tighter markets and the detailed reviews in terms of the loan proceeds and how we deal with that. Line of credits are expensive today, close to 10% if you had to draw down on them. And banks are not willing to give us bigger lines of credit as they used to because it's the cost of hedging those lines. There are products for condominiums that are available to borrow. So that doesn't mean that there's no availability in terms of lending for condominiums. There are newer products with more flexibility out in the marketplace. One thing condominiums need to be aware of is that your bylaws that you require owner consent. Most are 66 2/3, some are 50%, but the majority you will require 66 2/3 consent of unit owners in order to borrow, and one needs to be mindful of that. So moving on, talking about mortgages and interest rates. So bracing for impact, higher interest rates. So we've all been talking about that. I hope nobody has a name of Martin. Please don't be offended by our illustration. During the pandemic, or 2020 to 2022, most of our portfolio at that time, and most buildings took advantage of low interest rates, were around 3%. Loans will mature, not long to go. We're talking about 2026 budgets, but most buildings between 2030, if not before, and there are some buildings before, but between 2030 and 2032, you will need to address your mortgage. And assuming if rates stay where they are today, okay, they're not going to be in the 3% range where they were, okay, there could be a significant impact compared to historical norms. So we want you to be prepared. And so we have developed, which you're going to see, those of you that are familiar with our budget template and what we generally present every year. This is new. It's an additional insert to help keep the boards and shareholders informed. And so I know this is a lot to absorb. I'm going to spend a few minutes on this because it's important, but this you are going to see in your budget as an additional insert for you to discuss at your board meetings and possibly want to communicate with your shareholders ahead of time. So let's start at the top on the left-hand side. Let's assume that your mortgage is going to mature in 2031. Your mortgage is locked in with an interest rate of 3%. The mortgage is $6 million, and your current debt service is $190,000. Let's assume it's principal and interest, or it's interest, whatever, but the debt service is $190,000, or it's interest only, and your maintenance, annual maintenance in 2025 is $5 million. Pause. Now, 2031 arrives, and interest rates are assuming at 6%. Okay, so without taking out any additional cash, okay, your new mortgage, if you had to just roll in the closing costs, will be $6,135,000. And assuming at 6%, the interest rate is doubled compared to your existing mortgage, the debt service goes from $190,000 to $370,000. So all of a sudden, you need $180,000 additional revenue that you need to generate from maintenance to cover your new debt service in 1 year. And the impact based on current mortgage over and above general year-to-year average increases, which can range from 4 to 5 to 8%, depending on your building. Without that average general increase, over and above that, you're going to have to, in 2031, you're going to have to increase your maintenance by 3.6% based on this scenario for maintenance. And that is a lot for a community to absorb, and it's a big sticker shock in 1 year, because if you need, for example, a 5%, which is on average the maintenance increase, all of a sudden you're going to need an 8.5% or a 9% increase in that year. And that is a lot for the community, could be a lot for a community to absorb. We want to try and possibly absorb the sticker shock number one. Number two is, because of interest rates being higher than the historical low, remember we have, and I'm going to talk a little bit about capital needs. I spoke about in professional fees, all the compliance that we're dealing with, and there's more to come, and you're going to have to deal with that in your capital budget, and that capital budget is going to be funded. Now, historically, because we've been in a low interest rate environment, we've generally funded capital needs through debt. That might no longer be affordable and might not be an option. So let's try and get ahead of it. And so this is something for the board to consider. If we need the 3.6% increase in maintenance based on today's maintenance to adjust for that new mortgage, let's start planning today. So in 2026 budget, let's add 0.7% to the maintenance increase. And going forward, you'll see in 27, 28, 29, until we get to the 3.6. So we're going to take an additional increase in maintenance each year. So we spread that increase until we get to 2031, that there's zero sticker shock when we have to address that. Okay. If interest rates are lower, as we monitor them year over year, we can always make that adjustment to the necessary maintenance increase, updating this analysis each year. So that's one. So we avoid the sticker shock and we're planning for the future. Number two is, you can see by taking in that additional maintenance increase, we're going to add those dollars to your reserve account, so that at the end of your 5-year planning process, we've added $500,000 to your reserve fund, which will go towards future capital funding, and will avoid the need, if you take out additional debt, that you wouldn't incur that additional expense because you're ahead of the curve. These are items to consider. And then I'm going to talk a little bit further in terms of how we deal with these type of contributions, both to benefit shareholders in terms of the increasing their cost basis and how to deal with the tax consequences of that. But this is a new insert. We think it's great for planning. We are obviously going to tie this to capital planning, and I'm going to talk a little bit and give you a demonstration, is don't automatically think that there isn't an option to borrow additional money. There is, even at the highest interest rate, and the impact on your community. And we're going to demonstrate that to you in an exercise in a little while. So talking about putting money into your reserves, something to be mindful of, where historically we were in a low interest rate environment, reserves earn virtually nothing. We obviously want to try and maximize our reserve funds and generate whatever returns we can. And we're giving you just a sort of an average, on average but it's going to be between 3.5% and 4% return you can generate on your reserves. And we'll give you some options in terms of, obviously we need to be conservative in terms of the way they're invested and that they're secure, but generally it's CDs and treasury bills, whichever's performing better, laddered, and then, high yield sweep accounts, government-backed money market accounts, which give good returns. Going on to income, and I'm going to come back to reserve management, options of funding capital needs and capital planning after I want just in terms of income. So maintenance and common charges need to cover the base operating expenses, which we spoke about in the pie chart. What drives those factors, we're going to deal about that. I'm going to have a checklist, which we're going to refer to just to double check that for you to have a checklist at the end of this. But in terms of income, just operate, and I'm referring purely to operating income, visibility on other revenue, sublet fees, alteration fees, smaller amounts such as storage fees, gym membership fees. When last were they updated? When were they last revisited? How can we make more use of generating some other form of income to supplement the burden of maintenance or common charges, interest on reserves, which should continue to build reserves, not to fund operations generally, and then your commercial revenue. It's a separate discussion. It's about the terms of the tenant type. Budgets have already adjusted to the renegotiations in terms of COVID, the pandemic, the impact of retail that we know about, and then making sure that you understand it if you have commercial space, understanding the lease costs, the re-lease costs, including build outs as part of the capital planning, because you need to build that into the cost. It's not purely the rents that you're going to generate by re-renting. And so where we can keep tenants in place, depending, it's important for us to be aware of that. Retail rents in Manhattan continue to recover. But popular shopping districts, average asking rents remain 20 to 30% lower. And we need to bear that in mind. How to fund capital needs, which I'm going to speak about in terms of be conscious of the mortgage maturity. So we have one plan in terms of planning ahead, understanding what funds will be needed. So when we speak about it, and everybody's heard me, in terms of making sure that we look at what lies ahead, the 1 year, the 5 year, and the 10-year capital plan, the different buckets in terms of compliance, infrastructure, and the wish list, which is important. So the compliance, first local law 11, which we've spoken about, that's an example of compliance, and it's cyclical. Infrastructure, elevators, controller boards, average lifespan 10 to 15 years. We know the average cost is over $100,000. We need to plan for that. And the wish list is in terms of lobby refresh, hallway refresh, gym refresh, amenities in general. And it's important for value. We want to maintain value and we want to appreciate value. And that's important. And these are all the items that we need to consider. I'm going to continue a little bit with capital planning after that, but I just want to talk about for a minute in terms of income and the importance of net operating losses and the tax consequence, because we have a lot going into play and in terms of building reserves, taking in additional revenue, if we go the plan of planning ahead for your mortgage maturity. And so let's talk about net operating losses, and that's something I would like you all to be aware of, which were NOLs, and how there has been a shift, and we want to just highlight this too. So historically, the expiring taxable depreciation expenses, so depreciation will adjust year over year, and your taxable income has an impact. So this really is, if the building after depreciation, if you have a surplus, how do you deal with the surplus and what is the taxable impact? So if you have a net operating carried forward loss, you can take any surplus that you generate after depreciation and offset it against the carried forward loss. Now, in 2017, there was a change in terms of where you could utilize 100% of that net operating loss, or you could offset any surplus against that. It was amended to 80%. However, there was and I'm being very simplistic and I'm not going into detail as a tax expert would, but in simplistic, there was a stay put in because of the CARES Act in terms of what came about during the pandemic, and that only was held until 2020. So in 2021, going forward, you can only utilize 80% of net operating losses carried forward. And so, for example, if you had $100,000 of surplus, you could only offset 80% of that, and you would be taxed on the $20,000. However, any net operating losses prior to 2020 you can utilize 100%. But we want to preserve those, although those will expire through 2037. So in short, and there's a lot of detail, and I'm being very, very simplistic here, we want to be mindful where we generate a surplus, depending if we take in additional income to fund future capital needs, or we have a surplus and because we perform better in one particular year. There are ways to address this. So firstly, in the audited financial statements, because you're going to have, well, what are our net operating losses carried forward? There's generally a note, and you can refer to the notes in the financial statements. We've spent a lot of, and you can have this discussion directly with your building accountant or one of our senior controllers. We've spent a lot of time internally so that we're well versed and we can guide you through this on how to address it. But generally, the way to address if we have a surplus, and we will deal with this now, when we present your 2026 budget, if we are projecting a surplus, we are going to talk to you of ways of how to mitigate possibly addressing the net operating loss, the NOL effect. And this is dealing with the flip tax, and this would be for discussion with your building accountant. If this is dealt with as operating income or classified as capital income to fund capital needs, the incremental compounding contribution, and a board resolution basically designating a portion of your maintenance to capital to reduce that surplus to fund reserves, and because that's a question often asked as to, well, we generated a surplus this year because we performed better in utilities, for example, which is volatile. So that you generated a surplus, it will go to reserves to fund future capital needs, but we need to formally designate that, and it can be done simply by a board resolution, which will also dealing with preserving your net operating losses carried forward. But please rely on your building accountant and our team that will guide you and highlight this to you at budget presentation and guide you through that. Now, going back to the decision when you have to refinance your mortgage, and I'm sure everybody is feeling very anxious about having to deal with the possible maintenance increase in terms of dealing with that. Also, sorry, I apologize, just to go back to net operating losses. I really refer to cooperatives in this. However, with condominiums, it has less of an impact because you have less flexibility because there's good and bad income. And again, I'm talking very high level and simplistic, and we will deal with this at a direct board level and with your buildings accountant at the time. So I'm not ignoring any condominiums board that are present here tonight. Going to capital funding. So we spoke about the mortgages, and historically we had low interest rates, and generally most buildings borrowed to fund those capital needs. Capital needs are becoming more onerous as all buildings are dealing with that. And so we did a little interesting exercise because we realized that we're dealing, and boards have this challenge, is that they're part of a community and they're trying to deal with the whole community, and they have a fiduciary duty. So let's hypothetically we take a mortgage that's maturing at 3.6%, and it's going to go to 6.2, and the capital needs, remember, it's a 10-year term generally, you're going to need $3 million to fund that, okay? And, oh, well, interest rates are at 6.2%, we can't afford to borrow an extra $3 million. Let us run and look at the impact on your community. So let's take the average out of pocket to generate the $3 million. And this is, again, it's just a hypothetical. It's an average. So scenario one, we're going to assess the $3 million over 3 years. So the impact to the community on average is going to be $1,000 per shareholder. If we're going to scenario two, we're going to borrow $1 million because we want to hedge in terms of debt, and we're going to assess $2 million. In years 1 to 3, this is the impact on your community, is going to be $700 a month or annually, and from years annually, and then years 4 to 10, it's going to be an additional $60 a month. So the total cost over 10 years, if you assess, is $36,000. If you split it and only assess 2 million and borrow an additional million, the cost in the shareholders' hands is an extra $30,000. And if you borrow an extra 2 million and only assess $1 million, then the net impact to the community is in total $26,000 over 10 years. However, I've rounded this for simplicity, and then also these figures don't contemplate the additional debt exposure after the 10-year period. This is just a simple dealing with the community, but it doesn't deal with the exposure of additional debt at the end of the next 10-year cycle. But bearing in mind that you do have options even at higher interest rates. In terms of capital improvements, I spoke about the 3 buckets and things that we need to consider, which is Local Law 97, limits on greenhouse and gas emissions, annual penalties. This is going to begin with the 2024 data. 2030 maximum emission will be limited or lowered. In your 2025 budget on the utility page, you will see the projected penalties. We will disclose that. It's in red. You'll see when it's due. You're going to refer to your Local Law 87 in terms of your recommended measures to avoid this. We're waiting for further rules on cogens, carbon offsets, and hardship filings in the Local Law 97 filing portal. And then again, Local Law 88 lighting and sub-meeting report is due by the end of 24, especially relating commercial spaces over 5,000 square feet. So we need to proceed with caution as these requirements are evolving. Again, unfortunately, we're running out of time, so I'm speeding up a little bit, but we are available and can respond. But, you have your facade inspection safety program, FISP, formerly known as Local Law 11. The filings every 5 years. Cycle 10 ranges from 2025 to 29. New requirements mandating more extensive inspections and are driving up costs. Be aware of rising mobilization costs, combined cycles where possible, and the Revenue Committee is working on improvements to the process, less sheds, netting, clarifying inspection requirements. Gas piping, Local Law 152, visual and device sniff test, and could result in expensive gas shutdowns. It's every 4 years. It's not a one and done. And cycle 2 ranges from 24 to 27, so we're right in that range. If your building has a garage, cycle 1 filing range is 22 to 27, and cycle 2 inspection will be required every 4 years. Parking safety inspection we covered, X-ray fluorescent testing, lead containment, what we spoke about, which is an additional compliance. And then not forgetting the maintaining value for your building, estimating useful life. As I spoke about infrastructure, boiler, elevator, roof. Another thing which Eric related to in terms of insurance and avoiding claims, sidewalk replacements, that falls under the infrastructure category. And then, the wish list that I referred to in the last bucket, which is amenities, halls, lobby, fitness, in terms of maintaining value. And I know that this sounds like a lot. We are here to guide you. We're here to support you. All that we have spoken about tonight, we will be addressing at your budget meeting for your specific building. We have an extensive expert team that will guide you through it. I am available. Eric's available. Our senior controller team, our entire controller team, we spend a lot of time on training and input that they can guide you through this process, that to help you make informed decisions. It's tough being volunteers, board members, and you have a fiduciary duty, but please, we want to assure you that we are here to support you through and guide you through this process. So, recap checklist for your budget meeting. Real estate taxes, we spoke about how that's made up and their function of the assessed value, and we'll show you the history and where you're heading there. Payroll, we know it's a union contract renewal year, 4 to 4.5%. Be mindful and be strategic in use of part-time workers, to be discussed. Insurance, Eric spoke about that in terms of umbrella liability prices are volatile, the 10% marker, and things that we should be mindful of. Utilities, again, also macro influences causing overall increases, on average 10%. Professional R&M, repairs and maintenance supplies, inflation driving up 5%. We spoke about those. Insurance, tariffs, compliance of these vendors, they're passing on those costs to us. And we're all dealing, unfortunately, with aging infrastructures that need to be addressed. Mortgages, so we're going to give you the forward look. It might not be pretty, but at least it will answer your questions, and we have a plan to possibly address your concerns and the concerns of the shareholders, and we want to get ahead of that communication. Understanding the timing of your capital compliance requirements, the facade, the cycles we spoke about, gas piping. So facade is 5 years, gas piping 4 years, Climate Mobilization Act through 2030, that's evolving. Garage inspections, it's a 6-year and the necessary repairs. Gas tech installations, new requirement in terms of lead paint testing and remediation, and then understanding your funding options, loans, assessments, transfer fees, flip taxes. And as I said, we're here to guide you through this process. And with this, as just a reminder of what Chelsea said at the beginning, we will not have time to get everybody's question and answer. We will take a few questions and answers. However, anybody that has put a question into the Q&A, Chelsea will be compiling that. We will be distributing that to our professionals tomorrow. And please give us a little bit of time, but you will get a response to your answer. If not that, we will be addressing it at your budget meeting. And again, we just wanted to thank you. We are available to you. Again, we understand that there's a lot to absorb. We covered a lot of material tonight, but please, we do have a plan to help you through this. And you're not alone. We represent over 250 buildings in New York City. You're all dealing with the same challenges. So thank you. And I'll hand it over to Chelsea to address any questions, and we'll try and answer them as best as we can with the time that we have left available. Thanks, Chelsea.
Thank you, Andre, and thank you, Eric, for a tremendous presentation with so much valuable information for all of us and for all of our boards. We have a handful of questions. We will get to a few of them. Before I jump into what is in the actual Q&A, there was one question submitted ahead of time that Eric has already answered, and he's asked me to read that out loud, the question and the answer. So the question was, can our co-op or a group of co-ops get a better deal for each owner's insurance by banding together? Eric's response to that was the diversity of ownership among the buildings would preclude a true master policy approach. However, to a great extent, we are banded together already, as the Orsted portfolio is treated like a program by our primary carriers. 110, 118 Riverside is included in that program. That tells us who asked this question. As a result, we have been able to negotiate better rates, terms, and conditions that are generally available in the open market. A really great question. Thank you for submitting that. Sorry for the lack of anonymity on that one. Eric has also gone ahead and answered a bunch of questions regarding insurance in the chat already. So I will go back to the top and answer some others. The first question, if the tax abatement is not renewed after FY27, how much will real estate taxes rise by? What does 17% refer to? And if
So
it's
that would be,
too specific to the buildings, Andre, just let me know and we will answer offline.
it's on average 17.5%. That is the average cost. However, I could not imagine that real estate taxes across the board would go up 17.5%. I think that there would be some form of tax reform of how that was calculated or how the abatement would operate and the relief that would be bundled, because every owner would be facing a 17.5% adjustment in real estate taxes. However, there is always a possibility. But the exposure is 17.5% so if you take your cost of your real estate taxes today, on average, it's 17.5% of that amount, and it is reflected in your budget. We do break it out separately, so you'll be able to see that dollar amount.
Thank you, Andre. The next question, why do commercial units need to pay an equivalent of the tax rebate to the building? It's not the same as a residential apartment not being the primary residence for the owner who sublets.
So it depends. So if it's a co-op and the commercial space does not receive an actual co-op tax abatement, it's only for residential owners. It depends on the classification. If the commercial does not receive a co-op tax abatement, and in a condominium, if it's classified as commercial professional, they do not qualify for the abatement.
Thank you. This next question pertains to the pie charts at the beginning of the presentation. In your pie chart showing proportion of expenses, does financial cost include payment of principal or is it interest only?
It would be interest only.
Thank you.
Generally.
Generally, yes.
Yeah.
Okay. If our building is refinancing the mortgage this year to cover capital project costs, and there has already been an increase in maintenance for debt service, does this info about mortgages apply to us that you've shared?
If you're refinancing this year, yes, it does. I mean, not the long-term planning, obviously, because you're refinancing this year, but in terms of the marketplace, yes, it does.
Great.
But and I think I know which building it is that's refinancing, and we will guide you through the process in terms of lenders that are available to you.
Great. Next question, and we will answer 2 or 3 more. Does a requirement for individual co-op TS to maintain homeowner insurance have an impact on the building's insurance premiums?
Not that it necessarily has a direct impact on the insurance premiums, but to the extent that a claim that might otherwise have to be covered in the case of a co-op by the building's insurance company that can be transferred to the appropriate party, in this case, likely the shareholder who hired the contractor whose employee was injured in that case, I think, to that extent, it does offer a great advantage because, that's one less loss, particularly a labor law loss that you'll have, on your loss experience. So, but there's no, it's not like homeowners insurance where, if you put an alarm system in your house, you get a 10% discount, and various other things that you can do to get discounts up front. That's not how commercial insurance works, but anything that you can do to mitigate against incurring claims on the building's insurance policy certainly helps to facilitate, better, experience and, the rates and terms and conditions advantages.
Thank you, Eric.
Mhm.
And the last question, and again, if this is something we should answer offline, let me know. The question is, what percentage of our co-op portfolio have no underlying mortgage?
Less than 1%.
Thank you. All right. That covers our Q&A for this evening.
Thank you, everybody, for taking the time to attend. I know that it was long. I know that there was a lot of information. A lot of it, some of you might have heard before. And for those who are newcomers, welcome, and thank you for spending the time with us this evening. We look forward to guiding you and presenting your specific budget. So thank you and have a great evening.
Indeed. Thank you, everyone.
Thank you, everyone. Have a wonderful evening. Good night.
Thanks.
Good night.
Good night.